Well, we got a couple of interesting numbers out today, and they kind of contradict each other. The first one is this inflation data that we got, 5.4% year over year, from what was that, last July to this July, I guess it is. That's a big jump. Over 5% inflation, that's a lot. People say, at least the media, shouldn't say people, ordinary people agree that that's a lot. The media is spinning it as, oh, well, it's lower than expected. Don't care. 5.4% inflation is a lot. It's more than this society is used to. We have not seen this kind of inflation in a long time, and it's been sustained for a decent period now. It's not long term yet. It's not been, it's not been a year that we have seen over 5% inflation year over year. And month over month, inflation has slowed quite a bit since last month. Last month it was 0.9%, which, of course, annualized. I mean, that would be almost 12%. That's ridiculously high. It was almost certain to fall month over month, or inflation was going to be lower month over month this past month than it was the month before. But 0.3% annualized, let's see, that's still 3.6, which is not 5, but it's still higher than we're used to in this country. Inflation is higher than we would want it to be. Actually, anything above 0 is higher than I want it to be. Frankly, I would like there to be deflation. I would like the price of things to go down so the cost of living goes down, so that way people are getting richer, so that you can get more for less. You don't have to work as hard to get the same amount of stuff. That would be nice. It would be nice that as a society, we got richer instead of poorer every year. Now, what's been driving this inflation? Obviously, it's been the fiscal tsunami coming out of Washington. After the shutdown of last year, as we all recall, Washington stepped in to fill the gap in GDP. There was a massive drop-off, a cratering in private production, in the private sector share of GDP, and the federal government came in and printed a bunch of money to try and fill that gap. Of course, when you try and fill GDP by just printing money, that is going to create a good bit of inflation, because you're not actually increasing production. You're not replacing that lost production with new production. By design, the federal government and the states were turning off the domestic economy, the real economy, and just replacing all of that with spending. You are overtly cutting off supply and jacking up demand. And so when you do that, the obvious textbook day one Econ 101 result of that is higher prices. Now the question has been, because we all knew that this was going to cause pretty significant inflation. The question has always been, how long is it going to go on? And the answer is, as long as the government continues to spend in the same way in which it has over the past year, because we know that tax receipts are not going up nearly fast enough to account for all of this spending. Now, what else matters is not just how much the government spends, but the way in which the government spends it. Because as I've talked about with QE, sure, technically, when the Federal Reserve does QE, quantitative easing, they are creating money and buying up assets, but that money, since it just goes into the deposit accounts of banks at the Fed, it doesn't really have a huge impact on inflation. And you can have the same idea when it comes to government spending. If the federal government spends money in a way in which it's not really getting into the real economy so much, it might not be as inflationary as we might think. the most inflationary thing the government can do is just hand out checks to ordinary Americans. Because those people, you give individual people free money, they're going to go out and spend it. So you can be pretty much guaranteed that's going to create the maximum amount of inflation. But when the government starts to put a lot of middlemen in between ordinary people in the real economy and that money, if the way that the money is distributed is that, hey, it goes to this federal agency and this federal agency issues grants to, this local machine politician who then distributes it out to all of his contractor buddies, and then they pay their employees with some of that money, you're not going to see as much inflation because you're going to have a bunch of middlemen who are keeping a whole lot of that money for themselves, and they're just going to put it and invest it in the stock market or something, or they will, go out and buy a mansion, and so it might stimulate demand for, giant mansions and real estate, but it's not necessarily going to get into consumer goods. And so, it's a difference between helicopter money and just corruption. The government can spend trillions of dollars on corruption, on just handing it out to well-connected folks. And then those folks are not necessarily going to take all that money that they've just been handed and go shopping every week. I mean, they might buy a lot, but they're not going to buy as much as if all that money that they were given was just handed out to poor people. And so while I think that all of this spending, whether it's just being handed out in the form of helicopter money to poor people or is going to corrupt well-connected insiders, I'm not for either of those things. I think that they're both bad. But one is clearly going to have a greater impact on inflation than the other. And this infrastructure bill, to me, does not look like, hey, we're going to print $3.5 trillion and hand it out to ordinary people in the form of stimmy checks. That's not what we're seeing here. What we're seeing here is a lot of corrupt bargaining. This is all special interests. This is all corrupt insiders and middlemen sucking off of the government teat. And so make no mistake, this infrastructure deal is absolutely inflationary, but it's not as inflationary as it could be. And so relative to the multiple rounds of stimmy checks that have gone out, because think about it, the stimmy checks compared to these overall big spending bills that have that went on in the wake of the last year and a half or so, the stimmy checks were a small portion of that percentage-wise in terms of actual cash, but they, in my opinion, are responsible for the largest share of the increase in prices. And so the government can print and spend a lot of money without creating what in most people's minds would be an appropriate level of inflation when you just kind of think about how big the numbers are. You think, oh, well, gee, government's spending $4 trillion that they're just going to print out of thin air. That's going to create a lot of inflation, right? Well, like I said, it's not necessarily. It all depends on how they do it. They might only create some inflation if they hand it all out to their buddies. Because, yeah, I mean, a portion of that money, these corrupt insiders are going to give some money to their wives to go shopping, and they're going to go and buy things, and then that'll, spur some retail demand, and then you're going to have retail workers who get paid some of that money in terms of commissions and things, and they'll go out and spend. So, yeah, but it's going to have it's going to get funneled through much smaller spigot. So because of the lack of stimmies, because it looks to me like what's going on through Congress right now is just, your typical run-of-the-mill corruption. I do not see it being as inflationary as what we have seen as the big spending bills of the past. And so inflation may continue to decelerate as we move forward, again, unless there are new stimmies. Now, something else which I think supports this thesis of decelerating inflation is the continued increase in reverse repos. Reverse repos today, to my knowledge, We've broken above $1 trillion a couple of times, and I've talked about those. One of the first time, I believe, was at the last day of a quarter, so it was for quarter-end rebalancing. Then I marked the occasion once again when we hit $1 trillion, but that was at a month end. So again, you can count some of that up to end of month rebalancing when banks want to get a bunch of safe assets on their balance sheet. They play sort of an accounting gimmick at the end of the month. But today, it's not the end of the month or the end of a quarter. We're in the middle of August, and reverse repos broke above $1 trillion. Now, what does this mean? Well, first of all, reverse repos are, in practice, what they are is it's a way for institutions to receive 5 basis point interest rates on their cash. And so that's 0.05%. Now, why would they do that? Why would they want to be in the reverse repo market? Why would they want $1 trillion? Because these are money market accounts, money market funds. Why would they rather be in the reverse repos rather than in the money market itself? Well, because in the money market, yields are below 5 basis points. That is to say that Treasury bills, short-term U.S. government debt, is yielding almost 0%. And this is not something that we would expect to see. We would not expect to see more and more reverse repos in an environment of accelerating inflation. To me, what that suggests is that the money market, the bond market, the treasury market in general, and these guys, have much more money at stake than I could even conceptualize in my head. They are not worried about inflation, or else yields should be rising, money should be getting drained out of the reverse repos because T-bill yields should be rising, and that's just not happening. And so for that reason, as well as what I said earlier, I can only believe that inflation is going to continue to decelerate. It's not going to go down. Remember, inflation never goes down. It never goes negative. We never unwind the price increases that are already set in. Prices go up. They never come back down. It's just a matter of how fast they're going up. And honestly, I don't know whether this is a good thing or a bad thing, because something that I've been convinced of for a while is that the bond market is going to be our last hope. Because what we need in this country are higher interest rates. We need to rein in this bubble, and we need to deleverage. We need a great deleveraging across the U.S. economy. We need a reset. Not a great reset, not a reset of private property rights. We need a reset of debt. We need a reset of prices. We need prices to fall and to deflate. And that's not going to happen unless interest rates rise. Now, counterintuitively, the only way in which interest rates are going to rise is if inflation pushes interest rates up higher. So, as strange as it sounds, I almost would like to believe that higher inflation is around the corner, because things have to get worse before they get better. But sadly, as of this moment, it would seem to me that the status quo is going to continue to prevail into the foreseeable future. By foreseeable, I mean the next few months. I had talked about in the past how things seem to me that there would be a reckoning around the time of the fall, around September, and we would know whether or not things are going to start to come unglued, or whether or not we're going to see a just continuation of the current malaise. And as of right now, I'm leaning towards the idea that we're going to see a continuation. But I think what I'm going to do, I might, if I have time, go back and listen to what I've said in the past about my, I think it was called The 3 Roads to Economic Ruin. It was me laying out the case that there's no way out, which I do firmly believe. I'm going to have to go back and revisit some of that so that I can properly update what I have to say, given the information and the knowledge that that I've been able to gain since then. So, with that said, I'll see you folks back here tomorrow.